And here we go. We are live. Carley Garner, welcome to the Mapper Forward podcast.
Thank you. I'm excited.
So am I. I'm equal parts excited and absolutely terrified about how silly I am going to look with all the stupid questions I have
No,
planned for you.
there's no reason to be scared.
For those that are joining us, thank you. Today's episode is sponsored by Elixir Specialty Coffee. And Carley, you haven't had Elixir yet, but you do have
No,
Elixir
I
with
do
you.
have. I have a fresh bottle. I've smelled it. Okay.
What did you think of how it smelled? Was it different?
It is definitely different. It smells good. It smells like coffee. So
Awesome.
I've never seen anything like it. Let's give it a shot.
Cheers to you.
I guess I should have brought a
glass.
It's fine. That would have been smarter.
Let's both do it in the bottle.
Okay.
Cheers.
Okay. Wow.
Very different, right?
It is different. I like it. It's not as, I told you earlier, I drink coffee, but only with like a ton of cream and sugar, so it doesn't taste like coffee. But this is pretty nice. It's smooth.
I'll have to keep hooking you up with some from one business owner to another.
All right. Yeah, that's good stuff.
Awesome. I'm glad you like it. Thank you so much for doing this.
Sure.
And shout out to Chris Versace for hooking this up for us. Chris has had me on his podcast, Cocktail Investing, for a little while, Tematica.
Okay. Sure.
And I said to him that I needed someone to help our industry understand the C market. And he was like, oh, I know who I'm gonna connect you with. And so you're here to save the coffee industry, lady.
Well, I don't know if I can do that, but I can at least explain what's going on or explain how our side of the world works.
So can you tell people what you do?
Sure. So I am a commodity broker. So we deal in futures and options on futures, including everything from metals, energies, currencies, treasuries, stock indices, and of course, coffee. So our clients buy and sell futures or buy and sell options based on speculations that they make in the market. So for example, if they think coffee prices are going up, they go long futures, they might buy call options, they make some sort of speculative action. Ironically, although most of our clients are speculators and most people that come to the futures markets are speculators, the primary purpose of the futures market is to hedge. So a coffee farmer or a corn farmer or somebody that wants to protect their price risk can use the futures markets to hedge. And we do have a handful of clients that we help do that sort of thing also.
All right. So a lot of what you just said, I heard like Ewok language.
Okay.
And let's be clear. Like, I wouldn't call myself an unintelligent woman. Like, I know some stuff, but for some reason, my brain doesn't compute when we talk about this stuff. And so I have done some research. I have tried to watch a ton of videos on what this stuff means, and I don't get it. So could you explain it to us in super simple terms?
Absolutely.
Thanks.
So it's not in anything in life where when we buy a gallon of milk or we buy a loaf of bread at the store, we're exchanging two items, right? We think that bread is more valuable than our dollar. It's the same thing when you're trading futures or options. I think it gets a little confusing because we talk about futures and options instead of just saying we're buying an obligation or an agreement. So let's kind of go down to the basic level here.
Yep.
So when you buy a coffee futures contract, you are basically agreeing to take delivery of that coffee when the contract expires. The reason the futures markets work is each contract is standardized. So I think what it's probably confusing for you in your industry also is, because you know too much about coffee. So there's coffee in Brazil, Vietnam, and all these different strands and all this kind of stuff. In the futures market, it's all standardized. We're not worried about which one tastes better or smells better or anything like that. It's all the same, and it's an X number of pounds, and that's it. And it doesn't matter where it comes from, it's all the same.
This is where it feels like there's like some weird fuckery going on because guys...
Yeah, it's complicated, but the coffee futures trade on the ICE exchange, and so supposedly the ICE exchange has storage. So if I did buy a coffee futures contract and I held it all the way to expiration, I would actually take delivery of that coffee at some point. Nobody ever does that. I mean, occasionally people do, but if you wanted to, that's really what the purpose of the market is for.
But so hold on, can I ask you something there? So nobody
Sure.
really does that. Are you talking speculators there? People who are trading on the C market that are actually in the coffee industry, they do that. They do though, right?
To be honest, I've never had a client that took delivery of coffee,
Okay.
but some other markets like grains and metals, it happens a little more frequently.
Okay.
I think mostly because in the U.S., there's really not any coffee farmers in the U.S., and so it's a little more complicated in a market like coffee.
You got to come to California then. We got some coffee farmers over here.
Awesome, yeah. So, but the idea of the futures markets is, I think I should probably say this also. The point of the futures markets is to shift price risk. You're shifting price risk from the speculator, or I'm sorry, from the hedger to the speculator. So, if let's just say that a speculator thinks coffee prices are going up, but a farmer wants to lock in his price, because as a farmer, as a business owner, you have budgets, and you know that you need to bring in X number of dollars to cover your expenses and to turn a profit. So a coffee farmer might say, well, if coffee is at $1.20 or $1.10, I can live with that. I can turn a profit. I want to lock in my price. And so what that farmer would do is go to the futures market, sell a futures contract. He locks in his price, and then the speculator who's on the other side of that buys it from him. And that speculator is saying, I'll take your price risk from you, and I'm hoping that the market goes up. There's a misconception that speculators that speculators always make money, and it's actually the exact opposite. Most speculators actually lose. It's really, really, really tough game. Everybody, if you hear people talking about how much money they're making, it's because they're not telling you about the money that they lost. It's just how it is. It's like if you go to Las Vegas and you talk to people, yep, they tell you how much they made. They never tell you that they lost 10,000 to make that 1,000. That's how it works. So in speculation, it can be gambling. I wouldn't go as far as to say trading futures and options is gambling, but if you put it on a spectrum, gambling's over here, investing is over here. We're somewhere in the middle. It's definitely not investing. It is speculating. It's a little bit of a gamble. A lot of people lose money. So as coffee prices were going lower, for the last couple of months, they've obviously since firmed up, but not everybody. A lot of that move was based on people selling, trend traders, speculators selling, and they probably pushed prices a little lower than what a normal natural market would bear. It does go the opposite way. When coffee prices are high, speculators push prices higher than they probably should go. So it goes both ways. But the reality is, and I can tell you from personal experience, as the market was falling, not everybody was making money. We were actually on the wrong side of the trade. We didn't expect coffee to drop below like $1.95, and of course it did. So it got a little painful for us, but that's part of the game.
Okay. So let's break all that down even further. I'm sorry if I keep taking you down the elementary route.
No worries.
All right. So a farmer plants their crop.
Okay.
They then decide, I want to minimize my risk. So I'm going to go and sell some contracts so that I can lock in the price that I'm going to get for a portion of my harvest, or all of my harvest if I want.
Correct.
Okay, so they go to the exchange, this mythical exchange in the sky. It's a digital exchange, I'm assuming.
It is.
Okay, and tell me when I go wrong here.
Okay.
So I absolutely will go wrong at some point. So they decide to sell a portion so that they can lock in the price, and it's up to them to lock in a price that works for them.
Correct. Right. Okay. So now, one thing to keep in mind about hedging, like the definition of a perfect hedge is to sell an equal amount, or a futures contract equal to whatever your product is in the cash market. So if you have X number of pounds of coffee, you would need to sell that's in the ground that you expect to harvest in 3 months or 6 months or whatever it is. Then you would sell futures contracts either equivalent to that if you wanted a perfect hedge, or you don't have to, I would advise most farmers not to fully hedge, partially hedge, because you want to leave some upside, because some years, you'd be really sad if you sold at 120 and coffee went to
I think I just understood what you said.
Yeah. So
sorry, that just was an exciting moment because the first time someone's used the word hedge and I understand. So I just want to explain that a little bit.
Okay.
Or re-explain it to you so I make sure I understand. So when you're hedging, what you're trying to do is you're trying to minimize your risk.
Yes.
And the way that you've done that is what you've said is, if I don't buy any futures contracts and I just decide I'm going to wait till this harvest is done and sell it all that way, I am 100% exposed depending on what the price is at the time.
Exactly. We actually call that cash market speculating, because farmers don't think of themselves as speculators, but if they're not hedging, they are speculating.
Okay. Yeah. So they're hedging. If they do, go and sell, if they do go and sell contracts, what they're doing is they're hedging their bets, for lack of a better term. They're hedging a portion of their crop to minimize their risk.
Right.
Even if by the time they sell, the market may be higher or lower than the contracts that they've sold, they've at least locked in a portion of it. Okay.
Correct. So the way that it would work is, if you're a farmer, the thing is, the reason people don't hedge or farmers don't hedge is because they're scared to miss out. It's the fear of missing out, the FOMO, right? They don't want one of those years where coffee explodes and they're not participating. So that's why people tend to not hedge. But the reality is, on most years, you're going to be a lot better off hedging than you wouldn't, because most years, especially you get into the summer months, June, July, coffee tends to dribble down. So the thing about hedging is you're basically making on one side and losing on the other. So
explain that part to me.
Okay. So let's say that you're a farmer, and let's say you hedge 100% of your crop. You expect to yield, a certain amount of it in 3 months. So you sell a futures contract that you think represents roughly what you're going to yield in 3 months. So as coffee prices go up, you're making money on your crop, because you'll be able to sell it for more eventually in the cash market, but you're losing money on your futures because you locked in a price. You sold them, you sold futures, and the futures price went up and you're short. So you're making money here, losing money there. If it goes the opposite way, let's say that you lock in your price in the futures market and coffee prices go down, you're making money on the future side, but you're losing money on the cash side. But in the end, it's supposed to balance out. It's not going to be perfect because there are so many different local markets for coffee. It's not as simple as saying all coffee around the world is the same. It's just not. But it will give you a little bit of a price hedge, and so that it will avoid the feast and famine part of the business, or at least mitigate that.
So when a coffee farmer, I'm very excited because I understood what you just said.
Okay, good.
You've no idea how good this is going for me. Woo! Okay, so a farmer then goes to the exchange. They sell. Let's say that so they suggest a price. Is that correct? They say, this is how much a contract I want to sell it for.
Okay. So actually, earlier I mentioned that everything is standardized. And because everything is standardized, everything trades almost like a stock. So if you've ever traded stocks, you pull up a trading platform and you just buy or sell with a click of a button. You can do that with coffee. You can buy or sell coffee in an instant, immediately, with just clicking your mouse. So it's that easy. You don't really have to call anyone or go to the exchange or anything. And to get access to the futures markets, you're correct. You do have to have a relationship with the exchange, but that's what brokers like us do. So our clients, you wouldn't open an account directly with the exchange, but the exchange would allow you to open an account with a brokerage like us or whoever else you choose. And we would provide you with a trading platform, and you could just pull up your computer and you could buy or sell futures according to what you need to hedge, or you could work with a broker and I could place the order for you. I mean, that's how brokerages work. You don't have to trade online, but the only reason I mention that, it's that easy. You could actually even on your cell phone buy or sell coffee futures to hedge. So it's super easy and convenient and quick.
Is there a minimum amount of money that you have to have if you want to sell a contract?
Okay. The margin for one contract, the last I checked was about $3,500, $3,400. So you're talking $3,000 to $4,000. Usually it changes, but for $4,000 you could sell one futures contract, and that's So.
And for anyone listening, we should baseline this to say C market is for commercial coffee. We're not, it can include specialty coffee, but we're talking about Arabica. And we are talking about people who specifically sell coffee through the C market, not people who are selling coffee through relationship buying. And Carley doesn't know about this side of the industry.
No, I do not.
So we're going to tell her about it a little later, but we're going to I just wanted to kind of help people understand what kind of coffee we're talking about. It's not all coffee. The part I struggle to get my head around is that this is not actually buying and selling coffee, is it?
No, all we're buying is basically, if it were,
this is the fuckery.
it is. It's just an agreement. It's the same as if we had an arrangement, like, I'll take your coffee off your hands in 3 months at this price, and we shook hands. It's the same thing, but instead of doing an individual transaction like that, it's all electronic and exchange traded. So. And
so okay, we talked about the farmer side, right? So I'm assuming that because I know there's not a lot of farmers out there other than the big hedge fund funded farms that can afford to have trading accounts or work through brokers. I'm assuming what they do is they sell their coffee. The dry mills are going to go and take their coffee to a space. I don't know whether it's a warehouse or a broker or whatever. That broker takes receipt of that coffee, and the brokerage house owns that coffee and has to sell, or however it works. Or there's import-export companies that are doing the trading. Okay, so let's say an import company or an export company, they have the trading accounts. They decide that they are going to sell contracts. Okay. On this side of it, when we have the person who is buying a contract, let's say it's your average Joe Schmo in Las Vegas where you are that knows nothing about coffee. Help me understand that.
Okay, so just to address one thing you mentioned, the barriers to entry are actually very small. So anybody with a couple $1,000s could open a futures account to trade coffee. I'm not saying they should, but as a coffee farmer, it's really, the ability to hedge is really open to almost anyone, even the small farmers. It's really, there's 10 minutes to fill out an application, and then you send a wire and you're good to go.
Yeah, just to help you on that, most farmers literally don't have that much money to do it.
Gotcha.
In a lot of origins, they can't afford cell phones.
Gotcha. Okay. All right. So this is definitely a side of the business that I don't necessarily hear from a lot. So it's awesome. It's definitely a learning experience. Okay. So you're talking about, like, if somebody in Las Vegas that wants to buy coffee,
without really buying on a speculative basis. So they're buying coffee, but they're not really buying the coffee.
They're buying a futures contract because they think coffee prices are going up.
They're going to they think they're going to make money.
They think they're going to make money, right?
Right.
Okay. So just to give you an idea of how much money you can make or lose trading coffee futures, each penny. So like if coffee goes from, I think right now it's like 105. It goes from like 105 to 106. You would make or lose $375 per contract. So if the market, in the last week alone, I think it moved 10 cents. So that's $3,750. So you could have easily, if you just had an account with the minimum margin, you would have either doubled your account or blown it out like in a week. So that's just how volatile it is. We recommend that people overfund their accounts. So if you're going to trade coffee with a margin of 3,000 to 4,000, maybe you want 10 or 15 in, because it gives you more room for error. Otherwise, you're going to have a really hard time making money. But as far as like a speculator that wants to get involved, again, the barriers to entry are super small. You fill out an application, send a couple thousand into the account, and you're good to go. There are some stipulations, like the government requires you have certain financial net worth and a certain amount of understanding and that sort of thing. They don't want people just blindly, gambling their retirement savings, not understanding what they're doing. Obviously, we make sure everybody's educated.
If only they had those kind of rules on people going and playing slot machines and
exactly.
We'd be saving some people's lives. Yes.
Yeah.
Anyway.
So, and as a broker, I find myself, obviously I can't tell the future. I don't know what the good trades are going to be and what the bad trades are going to be. It's just we're all speculating and trying to beat the markets, and it's not easy to do. But I do find myself talking people out of trading more often than talking them into trading, even though I work for commission. So if somebody trades, I make money. But I find that human nature is one, people are driven by fear and greed. And so they tend to want to trade too much, too many contracts, too much leverage, so it's definitely
it's highly emotional, isn't it? This whole trading.
In my opinion, if you've ever played sports, you hear your coach tell you that it's 5%, skill and it's 95% mental, and that's the same with trading. It's really just a big mental game.
Yeah. Wow.
Yeah.
You'd make a lot more money if you had no heart, lady.
Yeah, that's probably true.
I know. Trust me, I have over empathy as well.
Shoot.
Right.
Yeah.
All right. So let's talk about the person who they're going to trade. Am I saying that right? They're going to trade in futures contracts, but they don't actually have any intention of taking receipt of the goods.
Sure.
This confuses me.
Right. Okay. So it's confusing because, like I said, you don't have to, and here, I'm going to confuse you even more.
Thank you.
You can sell something before you buy it back. So like if you think coffee prices are going lower, and so we talked about coffee getting really cheap a couple of weeks ago.
Yep, 87.
Part of that was because a lot of speculators were selling into the whole, because the trend is your friend is the thought. So as coffee prices are going lower, people are selling contracts expecting it to go even lower, and then at some point they have to buy that contract back. So when they're selling, they're basically just saying, I will make delivery of coffee at some point in the future. But then when they buy it back, they're offsetting their obligation. So
is that another form of hedging?
It could be. So like somebody that was an end user of coffee, so someone that had a big coffee shop and had to purchase coffee, and they wanted to lock in their price today as opposed to waiting to see what coffee is 3 months from now, that person could sell futures to hedge their price risk. Yeah.
Okay. Yep. All right. So I'm going to try and explain back to you what you said to me to see if I understood any of it at all.
I'm sure you did.
So a person, let's say they buy at $1, and so they've bought a contract at $1.
Okay.
It goes to 95.
Okay.
And they're speculating that it's going to go lower. So they sell their contract.
Okay.
And then, so they're selling it because they're going to then buy another contract at lower than that. Is that correct?
Well, they could do that. So that happens all the time. So people, they buy coffee or whatever instrument they're trading. The market goes against them. They're losing money. They get scared. They don't want to be in anymore. So then they sell it, and then they try to buy it back in lower. So yeah, they could do that. Or what they could do is, here's what some people do, and I'm not saying it's a good idea.
This is not advice. We just want to do a blanket whole thing here. Carley's not giving anybody any financial advice.
Exactly. Thank you. Yeah. No problem. So what some people do is they buy coffee at $1. It goes to 95.
Buy the contract.
They buy the future. Yes. Sorry. They buy the futures contract at $1. It goes to 95. They don't like it. They're uncomfortable. They're scared. They don't want to lose more money. So they get out, and some of them will actually sell 2 contracts. That way they get out of the one that they had purchased, and then now they go short. So now they make money if the market goes down. Explain
that little bit to me. You introduced another word. Going short means betting against yourself. Is that right?
Going short means betting that prices are going to go down. Okay. So if you go short, you're saying it's going down. So if you go long one contract at $1, and then at 95 you sell 2, you sold one to offset the one that you purchased, and then you sold another one to actually go short and to try to make money on the way down.
But you had to have 2 to start with.
No, you don't have. You can sell before you ever own. So let's say that let's just start over. You don't have any positions on. You're flat coffee.
Okay.
You think the market's going down. Okay. So you sell one contract at $1, and then you hope that you can buy it back at 95 or 90. And if the market does go down, you can buy it back later at a lower price.
How do you sell something you didn't have? This is the fuckery thing again, isn't it?
People have a hard time wrapping their head around that. It's because you're not selling the coffee that's in storage. You're just selling an agreement to buy or sell coffee. Because you're selling an agreement
you own.
You don't own anything. Okay, so a futures contract is not an asset, it's a liability. A futures contract represents two sides. Somebody that has to make delivery in the future and someone that has to take delivery in the future. So it's a liability. So
I feel so dumb right now. It's so funny.
No, you're not stupid. It's as simple as, okay, so in futures it's confusing because we're buying and selling liabilities, not assets. But the same thing, you can sell stock short too. Like if you think a stock is going down, let's say that you think Amazon stock is too high and you think it's going to go down, you could sell it and then try to buy it back later. But in order for you to sell it, you have to borrow shares from your brokerage, then sell it, and then go down.
So you have to have something first.
So that's why people get confused with futures. But in futures, like a stock is an asset. A stock, you're buying a piece of a company. In futures, you're not buying a piece of coffee or a piece of corn. You're just buying an agreement to take part in a transaction later.
The part I don't understand though is how do you sell something you didn't buy in the first place?
Because you don't have to own it. You're just once you sell it, you're agreeing to participate in the transaction when the contract expires. But we already discussed that nobody does that. So to get out of that obligation, you buy it back. It's confusing. It takes a little getting used to.
I'm just going to assume that one will marinate in the tiny part of my brain that understands very little bit about this, but is learning. And I was happy to be the sacrificial lamb that asked all the silly questions, because I know that there are so many people out there in our industry that are like, I have no idea what they're talking about either.
Yeah.
So
I understand.
And I really appreciate your patience with this. I hope I'm not annoying you.
Oh, you're fine.
All right. So someone decides, so they buy, then they sell, right? That's how they anticipate. Go on.
Yeah. So to simplify, I think I've made it more complicated than it needs to be. So if you think a market's going up, what do? You buy it, right?
Right.
Because you want to, the goal is to buy low and sell high. So you buy it and then you'd hope that you sell it higher. But if you think a market's going down, you wouldn't want to buy it. But if you could, you'd like to sell it, right?
The part that my brain doesn't understand is you're selling something that you don't have.
Right.
So the penny will drop at some point. It's like,
it will.
After so much trying to understand hedging, the penny dropped here, which was
good.
And you said when we spoke on the phone, you're like, hedging's one of those things that, you don't get it for the longest amount of time and then just out of nowhere, it just makes sense. Yeah. I feel like that's with a lot of this stuff. If it's not your normal language.
No, it's not.
It's difficult. Like there's a lot of stuff in coffee that isn't your normal language that you want to learn about today as well.
Oh, good.
All right. So if somebody who is playing these speculative markets, the futures commodity market with coffee, if they let the contract expire, it means they intend to take physical ownership of the actual coffee. That's when we get into the real world, right?
Correct. If they bought the contract, yes. If they sold the contract and hold it all the way to expiration, then that means they have to actually produce the coffee to deliver.
Okay. Right.
So it's the opposite,
Okay, that all makes sense, funnily enough.
Okay.
Great. So but if a farmer wanted to, so another thing that I have heard people say is that it would be great if farmers could hedge against the contracts that they've sold. So does that mean, if I've understood anything in this conversation, I should be able to explain this myself. So it means that if they sold contracts that are lower than what the new price is when their contract that they sold expired, it means that tell me if the market is higher when they actually have to deliver on the coffee, what should they do to hedge that risk?
Okay. So when you buy or sell a futures contract and you intend to take it all the way to the end, you have to just kind of live with the price. So if you buy it and your goal is, I'm going to take delivery at the end of this contract in 3 months, so I'm going to buy a futures contract here. If at expiration coffee is cheaper, you're going to say, shoot, I shouldn't have done that because I could have just bought it in the cash market cheaper. Now I'm imposing myself. But that's part of the game. You are still obligated to take part in that transaction.
But if it's higher?
If it's higher, then
you're winning.
Then you're winning
in the cash market.
Yeah. Yep.
Okay.
Exactly.
So that's how that was the point of why you did this in the first place and didn't do 100% of your crop. Okay. Did the sun just come out in Vegas?
You know what? The light just came off. I'm sorry.
No, it looks great.
Turn on the office lights. Okay, it's back. Sorry. I didn't anticipate that one. I forgot.
Awesome.
It's on a timer because I usually try to wrap up around now. That's my cue to like get out of the office. But
you've got people to do these things for you. They're not actual people. They're electronic people.
Exactly.
That was outstanding. Alexa, turn on the lights. Do you not get creeped out by those?
No, I probably should, but I don't. I love it. It's awesome.
The convenience would be amazing.
Oh yeah.
I just hear those horror stories of people who like wake up in the middle of the night because Alexa starts laughing like a witch. Have you heard of that?
Yeah, our bug guy tried to do that to us once. So it's like anyone that you have come in service your house, you better trust them if you have Alexa around because they'll do that sort of thing. They'll turn alarms on or.
That sounds terrifying.
It's not so bad.
No, thanks. I'm having a hard enough time trying to understand what people are doing with the futures market, let alone that Alexa's going to take over your life and lock you in your house and then burn the house down and do all of that. I live in a strange world. So, all right. Tell me something that we as an industry are struggling with. And when I say we as an industry, I'm talking about people who don't trade this stuff, who aren't buying green coffee, who aren't, we're the baristas and the roasters and the business people, cafe owners and whatnot. We are struggling with the disconnect between the trading on the sea market and the physical supply chain.
Okay.
So there's no actual connection. Well, that's not true. So it can be technically completely removed from the physical supply chain unless the contracts expire, correct?
Yes, correct. Yes.
Okay. One other thing I wanted to ask you before we deep dive into that, are the people who are buying these contracts are not just the speculators. They're people who actually want to take physical ownership of this stuff as well, right?
Some of them are, yeah. So there are a lot, especially in coffee, there are people using the futures markets to hedge. And so they might be going along a futures contract with the absolute intention of taking delivery at some point, once the contract expires. So yes, absolutely. I mean, what I'm talking about in the speculative side is what most people use it for, but I would say like the bigger dollar transactions are the hedgers, the people that are either using it to lock in their price, eliminate their price risk, or are actually taking delivery at the end.
So an example of that would be, let's say I saw a video on someone doing cornflakes with this.
Okay.
So let's say a big cornflakes manufacturer buys corn.
Right.
They don't know, they have a set price that they have to sell it at.
Sure.
And let me know if I'm explaining this properly. They want to make sure that they acquire the corn within a certain margin that they have to spend on corn for the year to make their cereal.
Correct.
So what they do is they buy futures contracts that meet that purchasing budget, and that is seen as a form of hedging instead of waiting for the price of the time that they take ownership of it. Did I explain that properly?
Yeah, you understood it absolutely correctly. And so again, because they're basically locking in their price. So it doesn't matter, once they lock in their price, it doesn't matter what corn does. They don't care. I mean, their profit and loss is going to stay the same because they've locked in their price. They can budget. They can do what they need to do. They know exactly what their cost is.
Okay, so they do that. Then they let the contracts expire. They take ownership of the corn.
A lot of them do. Okay, so a lot of them will, but not always. Even somebody that's hedging may not actually take delivery of the corn or the coffee or whatever it is. They might offset it on the last day or a couple days before, and then maybe establish a new hedge in a futures contract that expires at a later date. And the reason they wouldn't actually accept the corn is, as you can imagine, there might be, producers or users in, who knows, Indiana, Florida, so they're all over the place. The CBOT, the commodity exchange for corn, is in Chicago, and then they have a couple warehouses throughout the country, but it's not convenient for people to take delivery from a warehouse that's 2,000 miles away. Right. So even though they need to lock in their price, and they won't necessarily take delivery of the corn because it's not convenient to take delivery at a warehouse that's thousands of miles away, they'll just lock their price in and then purchase from the warehouse that's down the street.
Right. So they're just playing it that way to hedge. That they're just using it specifically to hedge.
Yeah. So in other words, the hedger has two options. They can take delivery, or they can choose to offset their obligation and just use, take the profit that they made on their hedge, or the loss. If they made money in the cash market, they lost in their futures hedge, and vice versa. So they can just lock in their profit and loss in the futures account and move on with their lives. They don't have to take delivery. If it's convenient for them, they will. If the location and timing and everything's convenient, they will, but not always.
Is there always someone there to buy a contract that someone wants to sell?
It's ridiculous. It's crazy. So coffee does not trade 24 hours. Coffee has like really weird hours because London and US and all that kind of stuff. Basically for us on the West Coast, coffee opens in like the middle of the night, and then it closes at like 10:30 a.m. Pacific time. So it's really weird hours. But most commodities trade almost around the clock, like 23 hours a day. So they almost never close. Wow. And it's crazy. I've never, ever seen, except for maybe some of the obscure markets that nobody trades, but we're not talking about those. But for the most part, 24 hours a day, you can buy or sell. There's always someone to take the other side. In fact, there's always dozens or hundreds of people to take the other side of a trade. And so the transaction costs are minimal. I mean, a couple dollars in commission, and the bid-ask spread between like the buy and sell price are basically really tight. So there's really very, very low transaction costs, and it's instant. If I want to buy something, I can click on a button on my cell phone or on my computer, and by the time I get done touching the button, I'm filled. So it's really fast.
Wow. Okay.
Yeah, it's amazing.
That is incredible.
It is. Yeah.
It creates more of a gap between us on this side of the supply chain and those growing the coffee, but we'll talk about that later. So, so it's never this is a question. So it's never going to happen that somebody is getting close to their contract expiring, whether it be to fulfill the contract or to take ownership of, to fulfill, the contract with coffee, or to take receipt of the coffee. It's never going to be a situation where they can't.
Where
they can't move that along.
Sure. I don't want to say never, because I mean,
but it's highly unlikely.
It's unlikely. I've never witnessed that. There's always been someone to take the other side.
Okay. And who sets the price?
Okay, so that's a good question. Nobody is really setting the price. Buyers and sellers are setting the price. So this is where it gets confusing, because for every buyer, there's a seller, right? So if there's a transaction, one person's buying a futures contract and one person is selling it. So you would think the price would just stay steady, but it doesn't. And the reason is sometimes the buyers are more motivated than the sellers, and vice versa. And so if you really want, there's no such thing as setting prices. The price is what the market is. So like if you wanted to buy coffee futures, you would look at your trading platform, you would see two prices. You would see an order that you could buy at and an order that you could sell at. And those orders, or those prices, are represented by other traders that are working orders to buy or sell. So generally the bid-ask spread is like a tick or two, so it's like really liquid. It's kind of inconsequential. Not a big difference between the price you can buy and sell at. and you either choose to take whatever the price the market's currently trading at, or you can name your price. So you can say, I want to buy coffee futures at 95, even though we're at 105 now. You could say, I want to buy it at 95, just put the order in and let it work, and you're either not going to get filled, or if prices come back down to you, you will get filled.
Can that go the other way as well? Can a farmer turn
Sure.
around and say, I want to sell at $2?
Yes, yeah, absolutely. You could throw crazy prices out there and just let them work. They may never get filled, but that's your prerogative to put the order out there and see if someone will take it.
And am I right? And I know that Steve said this on the podcast, Steve Bannister from Ecom, when he was on.
Okay.
So he was telling us that it's completely anonymous. That's the point of having an exchange, right?
It is. It's anonymous. It didn't used to be back in the open outcry days. I'm sure you've seen the people waving, and it's not like that anymore. It's all electronic, and it's anonymous. You never know who's taking the other side. And honestly, you don't really care, because the exchange guarantees both sides of the transaction. So it's not like you have to know who that person is and know if you can trust them or not. It doesn't matter. The exchange is going to guarantee that everybody lives up to their side of the trade.
What's the exchange? Surely they're not doing that for free. So how much of are they getting out of that?
A couple bucks. But where actually the exchange has a pretty awesome business model. It's the brokers who really bear most of the risk. Mm-hmm. So the way that exchanges can guarantee transactions is because they require margin. We talked about somebody needs $3,000 or $4,000 in an account to trade coffee because the exchange requires that as margin. That's kind of their risk buffer. Most exchanges, when they set margins, they kind of go based on what they think would the maximum move in a single day would be. That way, if something really crazy happens, then hopefully that trader has enough money to cushion any losses that they sustain on that day. If they lose more than they have in a trading account, which can happen with futures because they're leveraged, then the client is expected to pay the difference. But if the client cannot pay the difference, the brokerage does. And so I've had to pay. Yeah, it's gotten expensive. Back now that everything's electronic and things are more transparent, doesn't happen as much. But in the old days when we were working off phones and paper tickets, things could slip through the cracks, and there was a few that were really, really expensive. And the client couldn't pay, and so I had to pay for them, which is why the exchange has a great business, because they have very little risk. They're guaranteeing the transaction, but we're taking all the risk. So.
And was it, from what I researched, I thought that the exchange existed to sort of phantom-like take the risk, but they're not really taking the risk. You're taking the risk.
They're really not taking the risk. I've never...
Even though they guarantee the contracts, they're not really taking any of the risk.
No, what they're doing, their job is to basically make sure that all the brokerages have enough margin in place and can withstand any price movements of any trades that their clients have on. So they're doing some administrative work, but they really are not taking any risk. No.
Have brokers always existed?
That's a good question. As far as I know, yeah.
Okay.
I think if you really went way, way, way back into like the early 1900s when the CBOT was first started, I think it was more of a they probably didn't even have a building. They're just, some farmers out there in the field transacting. But for the most part, yeah, I think brokers right off the bat, once everything became centralized and standardized, I think there were always brokers.
This is a good time to talk about relationship buying. So this is the part of it that I told you we would talk about that I'm not sure that you know about. So I assume that in the early days, a farmer had stuff that he wanted to sell.
Right.
And there were people that, owned a restaurant, the only restaurant in town, and they wanted to guarantee that they had enough supply. So they went and did a deal, a contract with the farmer.
Okay.
Directly. Right. Instead, and they decided that they didn't want to go through the exchange. They just went directly to the farmer, and I'm gonna guarantee you that I'm gonna buy 20% of your crop for the next 3 years. Okay. And I'm going to pay you when I take delivery of it, rather than what happens now where, it's going to, it could be 12 months from when they actually send the coffee.
Right. Okay.
so the farmers, and we'll talk about that as well, the cost of doing business, not just the cost of production. So we are going back to that as an industry. So
Interesting.
there are farmers that there is the commercial market. So we have a scale, up to 100, 0 to 100, and it's what we're talking about here is the specialty market. So technically, the specialty market is a coffee that scores 80 and above.
Okay.
Now, that's not to say that coffees that score 80 and above can't be traded on the sea. It's just that in order for relationship buying to happen,
Gotcha.
roasters are going to origin and making these contracts one-on-one with the farmers, separate from the sea, and working with importers and exporters to have the coffee delivered to them based on the contracts that they're doing one-on-one with the farmers. And so what's happening is you'll have farmers that have their commercial crops and they have their specialty crops. Obviously, it's more expensive to farm specialty crops.
Right.
So they are putting more effort. They're working more closely with the roasters so that the roasters can get exactly what they want, well, close to it. So they'll want more exotic varietals, or they want specific flavor profiles in the coffee, et cetera, et cetera. The farmers put more effort into that farming, and it is going to be more expensive. They're going to have agronomists come out. They're going to have fermentation specialists come out, teach them how to do that. But that's a part of the contract that the roaster has negotiated with the farmer. And what ends up happening is, and this is just an example, the prices that we're seeing that coffee and the prices that we pay for Elixir for that kind of coffee is green, not roasted, anywhere between $5 and $7 a pound.
Wow. Pricey.
Yep. So the average, there's a big push for transparency around this now, because what we've been seeing is that farmers have been cutting down their trees because they've planted just for the sea, and they are a year in, 2 years in, and they know where this is headed. They're going to have to take on board an astronomical amount of debt because of the cost of doing business.
Right.
And they don't want to, they've been there before. They're still trying to get out from under the crash of 12 years ago. And so they know that going in there again, they're better off planting macadamia trees. So if with this transparency model, what's happening is more people are going to the farmers and buying this coffee. $3, $4 isn't like it's about the lowest that people are going with regards to these relationship contracts.
Okay.
Which, as you can see, is much higher than.
Oh, absolutely. Yeah.
Huh. Let's say that ended up being like, and let's be real, like 180 million bags of coffee are produced and sold every year.
Right.
And so, we're not talking about the majority of the coffee market that's doing this at this point. What we're seeing is that the majority of coffee is being traded on the sea with companies like Sara Lee, Nestle, Starbucks, the top 5. They're buying 50% of the coffee around the world.
Wow.
So those guys are clearly trading through contracts on the futures market, and they're not using necessarily this model to purchase most of their coffee. But this is going to become more popular. Farmers are going to try, and it's another form of hedging, I guess.
Right.
If I've understood hedging right.
Yeah, it's a form of it. Yeah, absolutely. They're diversifying their income. Yeah, sure.
Is that something that would worry you? I mean, you trade on lots of futures markets. So, but if, let's say you were just trading on coffee. Is this something that you would care about and think about?
Sure. So, I mean, that's definitely interesting to me. And it happens a lot when commodity prices become depressed, like we've seen Arabica futures become really, really cheap just in the last couple of months. When that happens, people start looking for, farmers look for alternatives. So maybe it's macadamia nuts, maybe it's another, form of specialty coffee. So they take acres away from their Arabica and they plant something else. And so eventually it's going to push the price of all coffees back up. Or, as you might see, the specialty coffees actually go down in price while Arabica goes up. So it's interesting. And that happens a lot in soybeans and corn. We see each year farmers decide how many acres they're going to allocate to corn and cotton and soybeans and all this kind of stuff. And it affects the prices each and every year because, farmers are always going to plant what they think they can get the most money for. And so, but it plays with supply and demand on an annual basis. So it's definitely interesting.
Yeah, it's something that we're pushing very heavily as an industry. We at Mapper Forward have started a campaign, #ThisIsYourCoffeeFarmer, so that cafes and roasters can start introducing the face of the coffee farmer. You'll see in the pack that you got. Yeah. Did you see that little card in the?
You know what? I must have missed it. Shoot. I need to dig back in the box.
There was a little card that came in it, and it has the face of the coffee farmer, and it talks a little bit about who the coffee farmer is. Because
that's cool.
The crazy part about it was when I was surveying people here in San Diego and people online who were just coffee drinkers, not in the industry,
right?
A lot of people didn't even know that coffee came off a tree.
Really?
Yep. That was.
I'm not shocked.
I know I'm not shocked, but that does still scare me.
Yeah.
It's sad, right? So, we've started this campaign of #ThisIsYourCoffeeFarmer simply so that people can understand, or perhaps start a conversation around the idea that there's somebody whose blood, sweat, and tears have gone into producing this seed that we then roast, that we then grind and make either your bottle of elixir or your cup of coffee or whatever it is that we make.
Yeah, Americans we don't even think of stuff like that. We just
no.
Wow. And
this Aussie's out to change.
Good perspective. Good. All right.
If let's say we created a tipping point, like let's just shoot this shit. What could something like that do to a market?
I mean, it's hard to predict. Just on the basic information that I know, but I mean, it definitely is a game changer. The thing about commodities is they're pretty much renewable annually. So the fundamentals of this year can change dramatically next year and vice versa. But I mean, we've seen it. I still think coffee's cheap at $1.05. I think we're probably at some point going to see, maybe later in the year, I'm not saying now, but 120s, 130s, if we really do get a shift in farming patterns away from Arabica and towards something else, I think we could easily see the twos, but it's hard to say. There's all kinds of different factors that come into this. And another thing that people tend to overlook is currencies. If you look at the Brazilian currency and you look at coffee prices, it looks like almost the exact same chart. They peak at the same time, they bottom at the same time. So sometimes we try to analyze and say it's a supply issue, this is going on with the growing weather. And honestly, half the time when coffee's moving around, it's just a currency change. So something to keep in mind.
I hear people say that when they play the C market, a lot of the time they're making more money off the currency than they are off buying and selling the contract.
It could be, because coffee in the futures markets, it's priced in dollars. So if if somebody from Brazil, they'd have to basically trade coffee in US dollars. And if the dollar's going up, which it has been the last couple of years, they're making money. Even if they're losing on their futures, they might be making up a lot of the difference on the currency. Yeah.
Wow.
That'll eventually flip though. The dollar's not going to go up forever, but for now it's working.
Hey, bubbles are bubbles,
it can go,
right? They have to bubble.
Right. Eventually it's going to go the other way, but
yes. How much research do you guys do around these markets? From what I understand, when you're buying stocks, right, you're buying something that you're going to earn a dividend from, so it's an asset. right? So that's something that you understand a little bit about a company, et cetera, et cetera. With regards to futures, this is different. As you said, it's a liability. So in order for you to trade with, I guess, with more intelligence or with a higher potential rate of success, I imagine you have to understand a lot about the commodities that you're trading.
You do. I mean, we put a ton of research in. We are constantly looking at charts and data and all these sorts of things. What I think is interesting, like, is I majored in finance in college, and in college they kind of teach you that everything can be explained with an equation. And you just kind of learn that if you punch, you put in supply and demand and you get this, then that's what the price should be. And it really does not work that way, because we were talking earlier, prices are so emotional and markets are so emotional. So I've learned, I peek at supply demand figures or the market fundamentals, but honestly, I make most of the decisions, or my opinions are mostly formed on what does the chart look like, who is probably under the most duress, and because people that are, for example, a market can become dramatically oversold, like in coffee, you see it every once in a while, below the cost of production. So people are selling their crops and losing money, not because they want to or not because they agree with the price, but because they really don't have a choice, and it becomes an emotional thing for them, and they just can't take any more pain. And so it's the same in the futures markets or the cash market, or any of that. It's emotion. People are trading on emotion. It has nothing to do with fundamentals or what prices should be or what the equation tells us the price should be. So it's kind of a scary game, really, because there's no limits sometimes to the chaos in the short run. In the long run, fundamentals come into play, and then the markets revert back to realistic pricing. But in the short run, it can be really distorted.
So if a farmer needs to offload a contract now, can he do that? Like if they're short for money or anything like that, they can't use. They can.
They can, yeah. I mean, they can. Well, when you say offload, I apologize.
Sell. Sorry. I think if they want to sell a contract,
sell a futures contract.
Sell a futures contract.
So they could sell it at any time. So for example, a farmer that a couple weeks ago was probably extremely depressed and sad about the price of coffee, now that he sees it at 105, even if he thinks maybe it might go a little higher, it might be worth it to him to sell a futures contract here, lock in the 105 price. That way, at least he knows what his situation is. Because the hard part about farming or any business is not knowing what your costs are going to be, not knowing what your budget's going to look like. And that's almost an impossible way in the long run to run a business. So the more stability you can provide yourself on pricing, I think the better off the business is going to be.
When people are doing these trades, and this is going to the heart of what coffee people are super confused and pissed at the moment. When people are making these trades, do you think they think at all? Well, I can't ask you to speculate about that, but what's the general kind of approach that they teach traders about the real life consequences about what's going on?
So, I mean, deep down, I think anybody that's buying or selling coffee futures understands that there is an industry and a business and individual farmers behind that, but I don't think that plays into their decisions at all. I mean, they're speculating and trying to make money. That said, I mean, it can go both ways. When coffee prices jump up to $2-3, which I've seen a couple times in my career, nobody's complaining, even though speculators probably pushed it up 20-30% than higher than what it should be. So it goes both ways, and it's painful sometimes on one end and exciting on the other end. But in the reality, to answer your question, I don't think they think about that, but I don't think that people that are upset that speculators are pushing prices around also don't understand that most speculators are losing money. So it's not like they're just everybody's making money at somebody else's expense. It's actually the opposite.
Which kind of suggests to me that if people are losing money on the speculators' end and people are losing money at the farming end, the back end of that part of the supply chain, it doesn't seem that this is necessarily working for many people.
You're wondering who makes money. Well, the reality of the futures markets is 20% of the people are making the money, 80% are losing it. So those 20% of the people that have figured it out are doing very, very, very well. everyone else is not doing so well.
Are they using quants? Are they using like machine learning to teach them?
Actually, and that's another thing also. People assume like there's a lot of algo systems out there that just automatically buy or sell based on different parameters. People assume that those just automatically make money, and it's actually the opposite as well. I've seen very few systems in the long run that make money, the automated ones. So you hear about it on TV and they talk about it, but what they do is they provide liquidity to the markets. And again, I remind you, the futures markets are there. The purpose of the futures markets is to hedge, for farmers to hedge so that they don't get into the situations that they get in without any type of price control or price management. And I'm not saying, I'm not a farmer. I know exactly. It's not easy. It's hard. I know there's all kinds of obstacles, and you're always, you don't want to be the guy that hedged while coffee explodes one year. I totally get it. But as a business owner, I do understand price control, and it really is a good idea. Even if you're not going to hedge all of your crop, you should hedge part of it.
So if they're forced to hedge at let's say about a month ago when it was at 87 cents, right? So that's when it just sounds to me like it's ridiculous to hedge anything, right?
I agree with you, yes. And that's the thing, people make that mistake a lot too, and we try to coach people away from that. So if you're going to hedge, whether it's your stock portfolio or coffee or whatever you're trying to hedge, you want to do it when prices are high. Like you want to do it when nobody thinks you need to hedge. Because if you wait until you have no other choice, you're going to be hedging at poor prices. And so you're really not doing yourself any good. Can you imagine if you hedged at 87 cents and now we're looking at 105 a couple weeks later? I mean, that's a tragedy.
So there's an affectionate name for you guys in the coffee industry.
Okay.
They call you the New York Mafia.
Okay. Those New Yorkers probably deserve that. As a broker,
you're all lumped in there.
Yeah. Those guys in New York are a little rough, and I do know a lot of guys that used to work on the exchanges in the soft, and I'm telling you, it's wasn't necessarily friendly down there. So
I can imagine.
I get it.
I can imagine. Only because these farmers are looking at this idea of hedging, let's say they're going to hedge part of their crop, and they're doing it at a time when the market's at 87.
Yeah.
And the cost of production, even for coffee that's going, so this is a good time for us to talk about the difference between cost of production and the cost of doing business for farmers. So let's assume, and this, I want to qualify this by saying, because farmers around the world are notoriously good at farming and not so great at bookkeeping and accounting, the actual cost of production per pound of coffee is nowhere to be found.
Nobody knows.
Nobody knows the average, right? And this is a big problem, and it's something that we keep hearing again and again and again in the last couple of months. Every time I go out and ask a farmer, I'm literally WhatsApping farmers saying, how many of you have insurance? Do you know how many responded that they have insurance? Out of about 60 that zero.
Yeah.
0 out of 60 farmers that I contacted have insurance. And 0 of them could tell me per lot how much the cost of production was per pound, because it takes years and years of someone who understands how to use spreadsheets and how to collect the data to understand this, and the majority of them aren't literate in that kind of thing.
Got it.
So there is there's speculation that it's somewhere between $1.80 and $2.80 for commercial coffee. So this isn't the specialty type of coffee, right?
All right.
So let's go with the low one, 180. Okay. Can you see that even at 180, that's just the cost of production. It's not the cost of doing business.
Sure.
So at $1.80, if they're hedging at, let's give them a high number of $1.20, they're still losing.
I totally get that. It is. Okay, I want to clarify also, though.
Please do.
While speculators, I will agree 100% speculators cause short-term price disruptions, maybe 10%, maybe 15% at the most is my guess. even if you take all the speculators out of the way, coffee still would have gotten to $1. It still would have it wouldn't have gotten as low as it did, but it would have gotten in this vicinity. And it really is, in the long run, it really is supply demand. It's not as simple as they make it sound in finance, but if there's a lot of supply, and I mean, demand for coffee is always there. That's never probably going to be a problem, but there's definitely a supply issue. And so unfortunately, I hate to say it, but the only way to fix a supply issue is to
reduce supply.
Yeah, right.
I remember there used to be stories when I first started in coffee where we were hearing of governments taking, when it was really high in supply,
right,
they would take the coffee and dump it in the ocean.
Dump it. Yep, I've heard stories like that. And I mean, it's unfortunate that that's how it works, but with prices this low, a lot of farmers will drop off. They'll switch to different crops, and prices will come back up. It happens in all commodities: corn, soybeans, all of them. They all experience it, and unfortunately it's a cycle that goes over and over and over again.
And so that's the natural ecosystem. We were talking about this on the phone the other day. This is the natural way that the ecosystem corrects itself.
It is, and it happens. I mean, each cycle is longer and shorter. It's not like you can predict when the cycle is going to end or begin, but you can look at, and you can see the pain in the prices. If you just look at a chart, you can see how painful it was, that dribble down. And it does it in all renewable commodities. You see that sort of thing. And the cure for low prices is low prices, because people stop farming it, people go do other things. Suddenly there's a lot less supply and the price will go back up. So just how it works.
So the top producers right now are Brazil, Colombia, Vietnam. They're the top three, right?
Right.
Now we've got China entering the market. You know this, right?
Mm-hmm.
So China's entering the market, and they're entering the market aggressively. So we also have technology entering the market that is making it. So coffee's a complex agricultural product, but as we get through, with all the research that's going into the growth of coffee, one would assume that it is going to become cheaper and cheaper to produce coffee as we mechanize.
I would agree with that.
And then we throw into the mix the idea of climate change. But let's hold off on climate change for a second, because so if we just look at the first part of the equation, where we've got Brazil, Colombia, and Vietnam have had killer crops, like absolutely huge yields the last few years.
Right.
And China's getting better and better at what they're doing. And by all accounts of everyone that I know that's been to coffee farms in China, they're the ones to watch.
Really? Okay.
We have this qualification in the coffee industry called Q grading, and it is about going and learning how to cup coffee and taste it so that you can score it. Remember that score I was telling you about out of 100? And a friend of mine, Felipe, went and taught a class about coffee farming. He's a Brazilian coffee farmer. He went and taught a class in China.
Wow.
And they had a 13-year-old girl who passed the Q grading course.
Yeah.
That's how young they're sending their kids to learn how to do this stuff, which is amazing. Absolutely amazing. So China's going to be a massive player in this market. And by all accounts, the coffee that I'm hearing is coming out of China, and the friends of mine who are world-class cuppers are saying that the coffee is tasting really great. So if we do have better technology and reduced cost of production, because we're having cheaper mechanization, means that we have less people needing to pick, right? I don't see how yields are going to slow down.
Yeah, I see what you're saying. Well, I mean, only time will tell. You never know. There's so many moving pieces, and we're dealing with people. We don't know what type of decisions they're going to make, so you never know. My guess is it'll probably push out a lot of the small farmers, and it'll just become, a big boys game. But there has been a couple times where coffee got down into the 50 cents. It hasn't happened in a long time, but
47 cents, I think it
yeah,
went down to.
so I mean, it's not impossible. So we just have to keep that in mind.
So if coffee continues to, if the yield of coffee continues to go up, we can't I mean, we can only speculate. We can, and again, for anyone who's listening, we're not, this is not advice about what the market's going to do.
Sure.
Okay. But people keep saying to me, oh, the futures market is not a supply and demand thing. And I can't get my head around that, because from what I'm understanding, it is a part of the equation.
It is. Okay. So the futures markets, because the contracts are deliverable, if you did hold the expiration, you could take or make delivery of coffee. Because they're tied to the cash market, they do absolutely
influence?
Follow along. Yeah, influence or follow along. I don't know if they may influence, but honestly, I don't think, like, let's just say you take the futures markets away and say there's no futures markets, it's only now individuals dealing with individuals and that sort of thing. I'm not sure the price would be, I mean, it would probably be total chaos, to be honest.
I think you might be right. Well, because then everybody has to have relationships with people.
Sure, exactly. Right, exactly.
And we know that humans are not good at that.
Right. And exactly. And another thing to keep in mind is also, if what you're saying is accurate and supply is going to continue to grow, that's probably true overall. Even if we knock out some of the, even if some of the small suppliers drop off out of the woodwork, or leave the business, go do something else or plant something else, we're still going to have supply issues. However, you always have to understand that Mother Nature is always lingering.
And to climate change.
Right. Yeah. So it just takes one disastrous year, bad weather or something, to really throw everything off kilter. So you just never know.
So that means that it does have an influence, because if it didn't, then if Mother Nature throws her 2 cents in, and like what happened in Central America, there was, I think it was leaf rust.
Right.
It's a kind of bacteria that gets into the crops and takes a few years to get out. So, it flattened their crops for a few years. So this is again where it gets confusing for me.
Sure.
So the contracts are anonymous, and am I understanding it correctly that when you buy a futures contract, you are not getting any details? So you don't know, let's say you let that contract expire, you don't know where it's coming from.
You have an idea. So the exchange has, like I said, I've never had a client take delivery of coffee, so I'd have to actually look and see. But most exchanges or most markets generally have like 2 or 3 warehouses. But you're right, you don't know exactly where that was sourced from. But it does have to meet certain standards. Like it's not going to be just complete.
It can't have mold on it. It needs to be deliverable. Right. So that's
I mean, it'll be of a specific grade and quality. Yeah.
But if Mother Nature kicks in and the supply goes down dramatically, how does that affect things?
So if you look at a price or a chart of coffee over the last 20 years, you'll notice every 3-5 years, whatever, you'll see a massive spike, and that's Mother Nature. And it's never predictable. And
spike in price or in supply?
In price. The supply will usually drop off pretty sharply, or at least the expectation. That's the crazy thing about markets. Even, not even just coffee, any market. You don't have to necessarily see a disruption in supply. If people just think there might be a disruption in supply, prices start moving. So it's really kind of crazy. But if there really is truly a supply disruption because of weather or some sort of natural disaster that nobody saw coming, you'll see coffee really take off. That coffee is one of the markets that prices generally soften over time. If you look at it, it kind of dribbles down a lot. But then one day, for no reason, it'll just start going up, and it's dramatic. The rallies can be really, really dramatic.
And is that because the market is being influenced by what's happening today, even though the futures the contracts that are being purchased today are for crops that haven't even been picked yet?
Yeah, absolutely. Yeah. So it's people,
crazy
hedgers and speculators that are basically trying to, position themselves just in case there's some sort of natural disaster or there's a freeze or whatever it is. You'll notice there's certain seasonal patterns in coffee. You generally see coffee prices kind of firm up like early in the year because people are worried about frost and that sort of thing, and then they'll soften throughout most of the summer, and that's because they're pulling out the premium, the risk premium that was built into prices just in case something happened. So it's an interesting game.
It really is. Tell me about differentials now.
Differentials, like, how do you mean?
So we hear that people so they'll trade a contract.
Okay.
And then what happens is they'll add a differential onto that contract that they can build more specifications into. So, this is new for you?
This is new. You're teaching me something. I've never heard of that. Okay.
I love conversations.
Yeah.
So you can buy a contract, and in it you can build in differentials so that you can qualify. It needs to have this kind of a quality level.
Okay.
All of these different kinds of things. That is a real thing that happens, so that they can pay a differential above the C price.
Yeah, that makes sense. Because I mean, if you think about it, the world's not perfect. Like if you're a farmer and you think you're going to have so much coffee and you think it's going to be of a specific grade, but then nature happens and it's not quite the quality you thought, or maybe it's better, maybe it's worse. So I mean, that makes sense. I've never experienced it. Like I said, I've never had a client that's gone through that process, but it makes sense, because nothing, we talk about commodities being fungible, and that means like one is not better than the other.
Say that word again?
Fungible. That just means like,
great word.
Yeah, it's a good word, right? Like one ear of corn is not better than the other, but in reality it is, right? I mean, some corn's better than others. Like as a broker or as a futures trader, we assume that everything's fungible, but it really isn't. So fungible. I don't know much about differentials, but it makes absolute sense.
I feel like progressives think that humans are fungible, but that's absolutely not right. Did I use it right there?
Yes.
Excellent. This country has taught me so much about politics.
It didn't used to be like this. How long have you been here? It's
only 3 years.
Oh, see, you came at like the best time.
When people say to me, what's it like to live in America? I'm like, I'm going to borrow the words of the great George Carlin.
Yeah.
I have a front row seat to the shit show that is America.
Yeah, I don't know. Everybody's lost
American
their mind.
politics.
Yeah, it's crazy.
Fuck yeah. It's I've lived here before. I lived in LA for a couple of years. But you just assume like LA's its own certain.
It's a little different, yeah.
Right.
Yeah.
It's a shithole. And I say that I can say that I lived in the heart of Hollywood.
Right.
But as much as I'm learning, and I'm very grateful to be living here during this time, because I want to be able to look back at this part of my life and say, oh no, it really happened. I lived here. And
I know.
No, it wasn't a dream. We are living in a simulation, and it is a clusterfuck.
It's totally crazy. Yeah, I agree.
Going back to coffee.
Anyway.
So, all right. So when somebody looks at the supply and demand, let's say we've got someone who isn't intending that contract to go to. Do you call going to term or looking for it to expire?
Yeah, going
holding
to expiration. But yeah, those all work.
Okay. So if they're not intending for it to go to term, they're purely looking at that situation as a money-making expedition. Correct?
Correct.
Okay.
Yep.
All right. Could we as an industry, in your opinion, find a way, is there any way that you could see that we could influence people to be prepared to pay more for those contracts, even though they're not intending on seeing those going to term?
Pay more in price, like you're saying, instead of buying coffee at $1, buying it at 105?
Yeah, because it doesn't sound like it's working for them, and it's not working for the farmers. But what if we could make it work for everyone? Is there a scenario that we could make that happen?
Well, I mean, the only way to make something like that happen is to peg prices, and pegging prices.
Illegal, right?
Yeah, and Or like, it's kind of like rent control apartments. Like, it really sounds like a great idea and it's good for everybody, but in the long run, it's not, because if you don't have a freely floating price discovery mechanism, then eventually everything gets out of whack. So, I mean, I can understand why that would be desirable, but I don't think, honestly, I think it would do more harm than good. So like, we'd try to fix one problem and we'd create all kinds of other issues.
Yeah. Why wouldn't it work?
Okay, because it would pull all the liquidity out of the markets. So I remember earlier I told you could trade any commodity almost 24 hours and in the blink of an eye. If you started controlling or manipulating prices like that, there would be no liquidity. Like, nobody would speculate because there's no point in it.
Okay.
And then the hedgers wouldn't have any way to hedge their price risk. So even though now a lot of them don't hedge anyway, they may not even miss it. Those that are trying to regulate their price risk would have no way to do it.
Can we get them to give a fuck at all?
The speculators?
Yeah.
I mean, I just don't think that, I don't think that the speculators are the ones that are causing coffee. I mean, I guess you could say, I think it's not, I don't think that they don't care. I just don't think.
Well, they're not aware, right?
Well, they're not aware, but I think even if you took all the speculation out, I don't think it's going to really change the problem. Like, maybe coffee doesn't go to 85, maybe it only goes to $1, but you're still going to be, people are still going to lose a lot of money on it. The farmers are still going to struggle to actually turn a profit on that. So the only way to fix it is to have less coffee. That's really the only way. Like, taking the speculative side out of things isn't going to change anything.
So it is a supply and demand thing. So
it is in the long run. Yeah. In the short run, it can get distorted. In the long run, it's absolutely supply and demand. So
we have to let the ecosystem fix itself.
Correct. Unfortunately,
so
that's
harsh,
my opinion. It is harsh, yeah. But I mean, it's like that in every industry. The restaurant industry, you know.
Oh yeah.
Every industry, it's like that. It's not fun. Most businesses fail. It's just the reality of it.
It's the consequence of having a free market, right?
Exactly, right.
And is coffee, I feel like I'm going to ask this and I don't know why I'm asking it, but is coffee a free market?
Yes, I would say it is. I mean, do you think it's not? I mean, is there something that makes you think it's not?
Well, when people are buying, when 5 companies have such a big stronghold on the volume, on the majority of the coffee that's being purchased.
Okay.
I just wonder, I have no fucking idea what I'm talking about, and I want to qualify this before I say it, so I might sound really stupid, but it just makes me wonder, if they're buying such huge amounts of coffee, could they not be setting the price themselves?
I would agree with you that if we're talking about like some sort of oligopoly or something like that, where they have so much influence, I think that in a way, I would say, yeah, they probably have economies of scale and buying power, and so they probably do depress prices a little bit. But I would say it can also go the other way. I'm assuming, like, if they get caught off guard and they're not hedging and suddenly coffee prices go to $2-3 because of a weather concern, you know, they could be the ones, again, pushing prices up.
What do you think the chances are that they're not hedging?
They're probably hedging. I guarantee they're hedging. Yeah.
Oh yeah.
If they're not, I would be
guys
shocked.
Are going to lose.
Yeah. Right.
No, the one thing I've definitely understood through the learning process of this on this podcast over the last couple of months is they have teams.
Oh yeah,
that
for sure.
Just sit there and trade on the sea market.
Mm-hmm. Well, they have to. I mean, they can't afford, any particular commodity can rise or drop 20-30% in a couple of weeks. It happens all the time. And so as a business, you can't possibly run a business like that. You really have to have some price stability. So they have no choice. They have to hedge.
What would it look like if, okay, help me understand this. So let's say demand drops.
Okay.
Not demand, sorry, supply drops.
Okay. All right.
that means, does that mean that given the thousands, I'm assuming there's thousands of contracts exchanged every day?
There are, yeah. It's
okay.
I should have checked the volume today, but I mean it's like tens of thousands.
Okay, so let's say tens of thousands of contracts are exchanged. Now, given there's this fuckery that's going on, that these contracts aren't actually tied to physical goods right now.
Okay.
Right? They're not necessarily influenced by what's going to happen in the future right now from a physical perspective. But if in the future some global catastrophe happens, an asteroid comes in, wipes out all of Brazil and China, their coffee crops, 2 asteroids because those countries aren't near each other. The contracts that have been traded previously that are tied to those those deliverables.
Right.
What happens if they can't be fulfilled?
So what you're talking about is a price squeeze, and that does happen occasionally. We saw it like in natural gas a couple years ago, where for whatever reason there was a disruption in the supply lines and they couldn't get natural gas to the markets quick enough. And so what you saw was natural gas went from like $2.50 to $6 in a month or so. So if that sort of thing happened in coffee, so there's always going to be enough coffee for those that are willing to pay for it. So you, like anybody that would have bought their futures contracts before the asteroids hit would be in awesome shape because they get bought in low. Now the coffee is worth, let's say they bought whatever, 120, now it's worth 320. They love life. Like they've locked in their price at 120. The people that had not purchased and now have to purchase at 320 are going to really be hating life because it's super expensive, but they will, if they really want it, they'll still pay. And so next thing you know, 320 might be 350 and then 370. When you get down into like the crunch of delivery and there's a limited supply relative to however many people want it, you get really big price squeezes. And sometimes the prices can get really out of whack, but it comes down to supply and demand. If you need coffee and you have to pay $4, you're going to pay $4 because you need it. If you don't have the money,
what if there isn't enough coffee to fulfill that?
Well,
is that possible?
Buyers would drop out. I mean, coffee is pretty inelastic, so maybe you'd run into that situation. But in theory, that's never happened because in theory, prices just get so expensive that people start dropping off and deciding they don't want it anymore.
So they'll sell their contract.
Right. So anybody that, correct, anyone that wants to take delivery could hold it to the end. And if there's not enough coffee, I mean, can't imagine that ever happening, but I guess it could.
So this is what I wanted to talk to you about.
Okay.
So the idea is that if we have enough coffee farmers that are frustrated enough with this cyclical kind of price going down and whatnot, we are definitely seeing more and more coffee farmers deciding to walk away from their farms. That's happening en masse.
Farming is really, really tough, especially coffee. Yeah.
Oh yeah.
And we're seeing the same thing in corn and soybeans, and so it's not just coffee, but yeah.
So if let's say we think about like a extreme situation, and climate change is definitely pushing us all into needing to think about these things, because as climate changes, we have shifts in the the microbiome that's in the soil. We have different funguses that are coming out as they cut down forests. We have new bugs that are coming into agricultural areas that are causing crops to die, and put more pressure on farmers. Then you add the sea market to that. They're just walking away. As you and I were talking about before, a lot of the caravan that is making its way up to the border that's just 15 minutes away from me, there's a lot of coffee pickers and coffee farmers that are in that caravan from Honduras and Guatemala, Costa Rica. Like a lot of that is what's going on there. What would happen to the C price? Well, again, and we're not saying this is what's going to happen, but we're just shooting the shit here. What happens if, I think that's an Australian term. Do you know what I mean by shooting the shit?
Yep, I've heard it before.
So if these drastic things do cause there not to be, and I'm not the only one that's talking about there not being enough coffee. We've done a number of discussions in the coffee industry over the last 12 months about are we running out of coffee? That's been the title of the discussion. If we were to run out of coffee, what would that do to the market? Let's say people have decided, I want to secure through relationship buying.
Sure. I mean, it's hard to say, but I've seen in my time in the commodity industry, I've seen commodities not just triple or quadruple in price, but I've seen much more than that. So eventually the market always finds a price where people start like they don't want to buy. It's too high. You know, if the price gets so high, buyers start dropping out. So eventually, in theory, if the market's efficient, you should never really run out of coffee because the price will just go up to the moon and only rich people will be able to buy it. But I mean,
it's not like
theory.
where
so you might run out, but it's not. Yeah, it would be
a boutique product.
Yeah, the only thing stopping people from buying it is money. You know what I mean? So people don't have unlimited money, but
so there will be enough supply,
very expensive.
But supply for people willing to pay at that price.
Yes, you said it. Yes.
Okay, so there's not enough supply for everyone that wants to buy it.
So correct. Only people that can afford to buy it. Yes.
So there is the way our industry is trying to, I guess this is a form of hedging for us, the way that we're trying to protect ourselves from that scenario happening, because it is something that we do see is on the horizon. Is this relationship buying?
Gotcha. I just thought of a good example because I was having a hard time articulating it, but do you follow Bitcoin?
I do. That's another one that's so hard to understand.
So if
trying
Bitcoin, and I think it was 2018. I think it was 2018. No, I take it back. Maybe 2017. Anyways, when it peaked out at like 20,000, it went from like a few bucks up to 20. That's what would happen in theory if something like that happened. Like there's no coffee and the price would just astronomically go parabolic. And
so let's explain to people who are listening that don't understand what happened there.
Okay, so in Bitcoin, there's a limited number of these electronic coins, and people were mining them, and it's complicated. I'm not a computer genius, so I don't understand exactly how. Some sort of mathematical equation that like
you have to solve it in order to buy it. And
totally crazy. Anyways, but the point is, there's only a small number of coins, and everybody wanted a piece. And so what happened is the price goes from like pennies or $1 or something like that over the course of a couple of years. It gets up to $20,000 for one Bitcoin. That's how crazy it got. So you can't say that there's not enough Bitcoin to go around. All you can say is people can't afford to buy Bitcoin because there's still the same supply, but the price has changed. Yeah.
So it's there for people who are prepared to pay for it.
Correct. Right.
And there's a number of articles that are coming out right now. It's interesting that this is the week that the coffee crisis is hitting mainstream media.
Yeah.
The Financial Times in London wrote an article about it today. The Age in Australia wrote about it over the weekend, that there's a coffee crisis going on, and they anticipate, as per what these articles were saying, that we may start to get to a point where coffee is a luxury product. And, you know, our cafes that are selling specialty coffee, this is already a coffee that is a more luxurious product than the standard kind of coffee that's being traded on the sea. You know, that's why it's called specialty coffee. It's a better quality coffee. But if coffee that's traded on the sea is going to become more expensive than specialty, the irony is just fucking mind-blowing. Don't you think?
Right. Yeah, it is very ironic, but it could happen.
So people keep saying to me, are the C market and the specialty market tied to each other? And technically, they're independent of each other. But
Okay.
when you look at it, and a coffee farmer from Panama, shout out to Wilford Jr., said to me the other day, he said, listen, how do you justify saying to somebody, I have a coffee here that's scoring 84 and I want you to pay me $4 a pound for it, green, and then a coffee that's scoring 78 or 79, which is technically commercial coffee, and that's 87 cents on the C?
Yeah.
Like there are only a few points
Sure.
difference, but massive gap in
Yeah.
the coffee, in the cost of the coffee. And this is where we start to say that although they're independent of each other,
Right.
they're not really
Sure.
independent of each other, because if the C market shifts up, then obviously the specialty market's going to shift up then.
Yeah, right. Well, I mean, they are kind of, I don't want to insult anyone, but they are kind of substitutes, you know? Not exactly, but they are. So I mean, they're going to be somewhat correlated or somewhat tied.
Do you find it interesting to know what's going on at the ground level of what you're trading?
Yeah, I mean, I think it's definitely a good perspective to have. I'm more familiar with, like, I grew up in a rural area, so I'm familiar with corn farmers and wheat farmers and ranchers. So that side of the business I've kind of am familiar with, and my parents were in the oil business, so I've been around that. But coffee, this is all new information to me, so I thank you for sharing.
Oh, you're welcome.
Yeah.
Did you grow up in Vegas, or did you
I
grow
grew
up?
up in Utah, like southeastern corner of Utah. So
Okay.
yeah, small
I bet
town, 1,200
Vegas is
people.
very different.
Oh yeah, very, very different. We didn't, the town I grew up in, we didn't even have a stoplight. Like, it was tiny.
Are you serious?
Yeah, dead serious. They have a stoplight now, but they didn't when I grew there. Yeah, one.
They have one stoplight.
And that's plenty for them.
Wow, it's
yeah.
just this country is so strange in
It's
that
different,
sense
yeah.
to me. I feel like every state should be its own country, like Europe.
Oh, absolutely. Yeah, it's totally different cultures wherever you go.
And the accents.
Yeah.
Accents are fantastic. The fact that I'm not going to attempt it. Whenever I try and speak in an American accent, I either sound like I'm from the South or I sound Indian. One of the two. I never nail it. Living in California, you'd think I'd figure out how to do a fucking California accent. No. Sometimes I sound Irish. Well, it doesn't work. Somebody wanted me to ask you about the role that quants play in all of this. And I know we touched on it, but what role do you see it playing in the future?
Okay.
Is machine learning going to get better and better at this?
I don't know. I mean, to be honest, maybe I just haven't been exposed to the right quant systems or algo systems, but they're not as efficient as you would think. You'd think computers could figure it all out, and how could they lose money, with their automated trading? But it's really not like that. Most of them do have pretty big drawdowns, and even if they make money in the long run, the returns are extremely volatile. What I've noticed, I started in the business in 2004, and in 2004 there really wasn't any of the automated system trading, like the computer trading. It was pick up the phone, call someone at the exchange on the floor and execute that way. So things have changed a lot. What I've noticed is the advantage has kind of shifted a little bit. It used to be the guys on the floor that were executing the trades probably had a little bit of an edge over everybody else, because they could see orders coming in and they could get, a feel for where the stop orders were and all that kind of stuff. Now I think the advantage has kind of shifted. There's no floors anymore. Everything's gone electronic. So now the computer traders probably have a teeny bit of an advantage just because it's so quick. It can react to things. Me, I would have to click on a mouse, and if I hear something on TV or something changes, like I have to place a trade. It might only take me a half a second, but a computer could do it in a split second, quarter of a second or something. So it's a much different game. They probably have a little bit of an advantage, but that doesn't mean they make money at it. I see a lot of, like I said, the returns are pretty volatile. But what I have noticed is they do push the prices around a little further than what maybe we used to see in the past, like 10 years ago, if the market started moving in one direction, there was some sort of limit to what the initial knee-jerk reaction would be. Now that limit's been stretched a little further. So I think there's a little more volatility during periods of like news announcements and that sort of thing. But in the big overall scheme of things, they've actually added a lot of liquidity to the market. So in normal
what does that mean? They add just cash to the market?
Liquidity, more buyers and sellers.
Okay.
So it's easier, like the bid-ask spreads are tighter. You can trade, like I mentioned, 23 hours a day. And a lot of that is because of the computer trading and stuff that's going on. So there's just a lot more people buying and selling and keeping prices stable. So in normal market conditions, it's actually probably a stabilizing effect. But in volatile market conditions, it exacerbates the moves a little bit. So it's different. But
does the fact that robots can't, let me say this a different way. When these machines are doing all of these trades, what kind of information do they get fed? Do they get fed things about supply and demand and whatnot?
I mean, each one is different and unique, and sometimes they're looking at like technical oscillators. I don't know how familiar you are with that sort of stuff, but there's like momentum indicators and things, and so programmers will include those. Sometimes it's news driven. So there's actually, I've known of some that kind of follow Twitter and they look for keywords on Twitter and they use that. I'm not saying that's a good idea. I think it's a horrible idea.
Crazy.
But that's, some of them do that. So yeah.
I'm sure some of them follow weather patterns and whatnot.
Yep, absolutely.
I know that there are sites that are weather patterns purely by commodity stocks.
Yeah, and there's a lot of commodity traders pay a lot of money to get access to weather forecasts and things like that, like not just the stuff you get on the Weather Channel, but a little more in depth. I've never had a whole lot of luck using those because, first of all, if we're speculating on the price of a commodity and now suddenly we're speculating on weather, because weather's not always an exact science either.
Full piece of it's just a piece of the puzzle. It's not the whole thing. It sounds like that these quants or algorithms are always going to be reactive.
I'd say that's probably accurate. Yeah.
That doesn't sound like a great place to be making money from.
I mean, I guess their theory is if they're quick enough and they're just trying, you have to keep in mind also, like some futures speculators and especially the quant traders and all that kind of stuff, they're not buying a futures contract today and then selling it 3 days from now. Most of the time they're in and out in a couple of minutes. So it can be really fast. Yeah.
Can you make money that quickly?
I mean, in theory, you could. If you're right, you can make or lose. But yeah, you could. The market moves fast. You'd be surprised.
I've taken to posting the C market price on our Instagram stories every day.
Okay. All right.
And so I watch it for like 15 minutes every morning while I'm sitting there having a cup of tea or coffee or elixir or whatever. And I'm like, who the fuck is doing this?
Yeah.
How can it move from like 105 to 106 back down to 104 in the space of 15 minutes?
Yeah, it's crazy. If you look at it in a very short time frame, it is total insanity. I'll agree with you. And it's people just changing their opinion, or other people. Like sometimes people are buying or selling not because they have an opinion in the market, but because they're hedging. So you might be seeing, hedger come in and sell, and then somebody else coming in and buy. So it's thousands and thousands of people all expressing their opinions all in real time. So it's really, really crazy.
That's a great way to describe it. It's an expression of their opinion because they believe the market's going to do it's their opinion that the market's going to do a certain thing.
Right. So, and in the long run, if they're wrong, they will pay dearly. So it's not something like they can, if you start getting a situation where speculators are piling on, like we saw in coffee when prices got really cheap, I will admit that it was just one of those things. Prices kept going down every day, so they thought it was easy to sell it. But can you imagine if you're just complacently short, and from 2 weeks ago, and now you're probably sitting on massive losses. So anybody that's wrong, speculating and is wrong, will pay very, very handsomely.
Wow.
So
It's, first of all, my mind's blown by how much clarity I've got so far from this conversation.
well, that's good.
It's fantastic. I can't thank you enough for what I've learned
Yeah.
so far. I do have a couple more questions, if that's okay.
Okay, sure.
So we've talked about it's the speculation in the market that shifts it up or down.
In the short run, yeah.
In the short run.
In the long run, it really truly is hedgers, supply demand. The price of a futures contract is tied to delivery of a commodity. So you're not going to see okay, I think I should have pointed this out from the very get-go, and I failed to. The reason the futures market is such a great way for great method of price discovery is because a futures contract represents delivery of the commodity. Therefore, as we get closer to expiration, the price of the cash commodity and the price of the futures contract come together. So at expiration, you're going to see if you looked at, coffee is complicated because there's so many different local markets and all these sorts of things. Mm-hmm. But the product that would be delivered based on that futures contract, the cash market price has to be exactly what the futures price settles at. So that's what keeps them all tied together.
But that contract, at some point, whoever's got it at the time of expiration, somebody's going to have to take delivery of that coffee. Is that correct?
Correct. Yeah. Yes.
So a contract's created, and it's once the contract has been made, it's got an expiration date tied to it. Is that correct?
Correct. Yes.
Okay. So at some point, that contract has to be fulfilled. So it's kind of like musical chairs or pass the parcel, I guess. So once the music stops,
it is right.
Somebody has to take. It's not like you can. That's going to go. It has an expiration date. It
has an expiration date. Yes. And that expiration, if you hold it all the way to expiration to the delivery process, you take the price that it is. There's no negotiating or anything. It is what it is.
Who starts the contract?
Who starts it? It's not really started.
Doesn't it need to be?
It's confusing. It's not like there's a limit. Okay. So in stocks, if a company issues 1 million shares, people are buying and selling those millions amongst each other, right?
Right.
But the number of shares stays the same mostly unless they change something. In futures, there's not a set number of shares or a set number of contracts. It's just the market determines how many contracts are going to be traded. So in a market that trades tens or 20,000 contracts a day, you can imagine probably we'll just assume half are buying and half are selling, and they all kind of offset each other. At the end, you might have a couple hundred people that are actually going to take delivery of that. So at the end of the contract, or when it goes into expiration, most people have already offset their obligations. They've made or lost their money. They're done. They're out. And then you just have a handful of people that actually go into the delivery process. But it might be 5 people. It might be 400. There's not really a set number on that.
But it's unlimited. So let's say the whole coffee industry decided today, all right, we're all very rich, because that's absolutely not true. But let's, in a fantasy land, we're all rich. We're going to buy a contract, right? Mm-hmm. And we're going to let it ride to expiration.
All the way. Okay.
That's a lot of contracts. And
sure. So the exchanges kind of estimate how much they're going to need, how much coffee they need on hand and who's going to actually go into the delivery process. So they have an idea based on history. And then once they get closer to expiration, they start assigning people what they call delivery notices, so they can match buyers and sellers. So it's a whole process. If everybody decided to take delivery, I would assume that'd cause a problem. But you have to keep in mind, if everybody that is long agrees to take delivery, and then everybody's short.
If everyone's long.
So if you bought the contract.
Okay.
So if you bought the contract and you're agreeing to take delivery, in order for you to buy that contract, someone had to sell it to you, and that seller is the one that would make delivery. So the seller has the coffee, the buyer wants the coffee. So at the end, they would all match up, and there in theory, would be enough coffee to go around.
Technically, everything's going to match up.
Right. Yeah.
Unless there's a disaster.
Unless there's a disaster. Yes.
And the farmer's like, oh shit, I don't have the coffee. I know I said I was going to give you the coffee, but Mother Nature peaced out on me this year, and
right.
she handed me some fungus that just ate everything.
Sure. I don't know what would happen in that situation, but that is possible.
Are those terms written into these contracts? Because they're not pieces of paper, are they?
Sure.
They're not actual stipulating.
Well,
details.
If you go to the exchange's website, they list all of the delivery rules and all the
so they
all
do have
the stuff. There's pages and pages of, and it's if you really wanted to read it, there are terms. Yes.
I think I have to actually go and check this out, only because I'm really trying hard to understand.
Yeah.
What all of this means, because one, I don't understand any of it. I understand a lot more now thanks to you. In like almost 2 hours, I feel like I've understood this more. And I hope that anyone who's listening understands this a little bit better. I hope I didn't fuck this up. But I understand a lot more, which is important. Yay. But I do want to know what would happen, because there's a lot of speculation in the supply chain right now that this is a very plausible situation, that we may run out of coffee, because it's getting harder and harder to grow coffee in the current typical coffee growing regions. Just because we're experiencing these massive yields right now, we don't know if that's going to continue to grow if we do want to include climate change in that equation that we were talking about earlier.
I mean, my guess is if something like that did happen and the supply of coffee shrunk, new suppliers would come on board. So places in, areas of the world that never grew coffee before would say, hey, maybe there's some money in this, and they'd start growing coffee. So as an entrepreneur, I would have to say that it would eventually, maybe for a year or two, things might be really tight, but it would eventually correct itself.
That's the point of free markets, I guess. It's a model that kind of finds its own ecosystem. It's very Darwinian.
It is. It's very Darwin, and it's very, you're right. It is.
It's brutal. Like
it
nature
is brutal. It's unpleasant, but in the end, it is what it is.
Is there anybody that regulates these processes on the
futures side? Yeah, the futures industry is highly regulated. So in the US, we have the NFA, which is the National Futures Association, and then we also have the CFTC, which is the Commodity Futures Trading Commission. And then the exchanges themselves have regulatory bodies. So there's tons of regulations and price discovery examinations and all kinds of crazy stuff. They really go above and beyond to make sure there's no blatant manipulation in pricing. Like, for example, you can, in certain markets, the government basically puts, well, it's not the government, I should say, the exchange puts limits on how many contracts you can hold in a particular market before you have to actually report it.
A broker or
a speculator. So any individual trading account. There's not necessarily, I shouldn't say it's limits on how many you can hold. You can hold beyond the limit, but if you do, you have to report it to the exchange, and your broker has to have it basically reported to the exchange, and the regulators are aware of it. And so, so it's no longer anonymous, basically, once you go over a certain number of contracts.
Who owns exchanges? Like, who owns the exchange that deals with coffee?
Okay, so coffee is traded on the ICE exchange. It's actually, they've been bought out a few times, but it's actually New York Stock, the same parent company of, New York Stock Exchange is kind of the parent company, I believe, of the ICE. Most U.S. futures markets are owned by the CME, the Chicago Mercantile Exchange Group. ICE is a different one. The only products that really only trade on ICE are coffee, cocoa, sugar, orange juice. Everything else trades on the other exchanges.
And so let's say I discover a new commodity.
Okay.
Let's say, I don't know, some new tree that everybody wants, bears fruit. I found it in the Amazon. I brought it back.
Sure. And
I've decided I'm going to farm the shit out of this. And then over the span of 10 years, other people do this.
Mm-hmm.
Can I decide I'm going to get out of the farming, I'm going to set up an exchange, to create a futures market for this commodity?
I mean, in theory, I guess you could, but you'd have to get approval from regulators, and there would be all kinds of stipulations
I own lots
and
of
rules.
Bitcoin. Let's assume I have lots and lots and lots of Bitcoin.
Right.
I'm the person who started Bitcoin.
Okay.
So I have a couple tucked under my pillow. If I've got enough money to fund an exchange, and I know enough people to get that started, it's possible?
Sure. It's possible. Sure. There's been a few exchanges that were kind of different. Like, I don't know if you've heard of Nadex. They did binary options. There's been a few that have tried to start up on the side, outside of the CME or ICE. It would be a tough business. But in theory, you could, yeah.
Because I know in Colombia, God, I hope I actually do know this and I'm not making it up. But I know that in Colombia, they're trying to make themselves independent of the sea. Or they're trying to start something separate from the CETA for the exchange of coffee, which would be interesting.
That would be. Right.
I just think the whole thing's going to get very interesting moving forward, because farmers are trying, they want to be successful, but they feel like for far too long, it's been an absolute fuck you.
Yeah.
And
I can see how they would feel that way. I mean, it's a tough game for sure. Trust me, soybean farmers are not feeling any better with the, I don't know if you follow soybeans, but with the Trump tariffs on China, soybean prices dropped dramatically in a short amount of time, and they just can't seem to get out of the hole. So,
well, they've got the added bullshit of the Monsanto seeds, owning, and all this fuckery that Monsanto is going through right now with the litigation. And did you hear that the last lawsuit that was settled?
No. Oh, yeah.
$2 billion.
Now that you mention it, I did hear that. It's a lot of money.
Yeah. And there's 13,000 cases now being brought against Monsanto. I mean, all of this kind of stuff plays into it, right?
Right. Yeah. Same idea.
Wow. It's you live in a stressful world, lady.
It is stressful. I agree.
Do you think there's a period of time that you could do it for? Or could you do this the rest of your life?
Well, we'll see. I'm over a decade in. I probably have another decade left, and then we'll go from there. But
wow.
One day I'd like to retire and just kind of hang out and enjoy.
All of us entrepreneurs say that.
It'll probably never happen. I'll be doing this in 30 years.
People say to me all the time, like, what are you going to do when you sell Elixir? I'm like, I'm going to eat my way around the world for a year.
There you go.
And I'm going to sleep my way around the world for another year. And then I will probably have to go back and do something else, because get back to work. I just couldn't.
Yeah.
I'm going to be tired by the time that happens. And Map It Forward's not slowing down anytime soon.
Yeah.
But I definitely want to take a year off and just eat my vegan ass around the world.
Yeah, that'd be great.
I'll come and visit you.
Yeah, come on over.
Carley, thank you so much.
Yeah,
this has
you're
been
welcome.
a wonderful conversation. I have learned far more than I thought I would, and I've understood so much. If people want to get in contact with you, how can they do that?
DeCarleyTrading.com is our website.
We'll include a link in the show notes. And I know that you don't encourage people to what's the disclaimer that you put on your website and pretty much every single social platform that you have?
There is substantial risk in trading futures and options. That one?
Yeah, that one in quotes, like everything that you've got. I understand that's a regulatory thing, right? But if people did want to, I keep hearing people say, I'd love to get into trading stocks. If they wanted to do futures, you do that kind of thing.
Yeah, right? Absolutely. We deal with traders of all experience levels, sizes. Like, some guys open with a couple thousand, some guys open with millions, and we have everything in between. Some people have never traded before, some people trade for a living. And so we help people on all ends of the spectrum. And like I said, we have trading platform. Most of our clients trade online through a trading platform, and then we just kind of are here to help them and guide them along the way.
Because I know that there are some coffee farmers that may have a few $1,000s that they can invest. They're the kind of people who can get in contact with you and you can guide them along the way, right?
Yeah, it was something like that. Like if they wanted to hedge their price exposure, but not do it with futures, because futures is
risky.
Well, the idea is to hedge is to reduce the risk, but at the same time, like if they want a partial hedge or something like that, we could just buy put options, which is we don't have time to get into it today, but it's like, basically
what?
It's a whole other thing. But it's basically to give you an idea, we could buy a contract that limits their risk under 95 cents or something like that.
Okay.
So that way they would, their cash crop would freely float like it normally does, but there would be a price floor at 95 cents, and we can usually buy that for $500, $600, $700, $800, depending on the time horizon.
Okay. Because I know that there are a couple of farmers that are going to be able to be in that position, and they can contact you, and you'll look after them. And
we would love to hear from them. Thank you.
Absolutely. And if anyone who is listening to this does want to get in contact with Carley, just email us. You can email me directly, lee@mapperforward.org, and I will make the introduction to Carley, no problem.
Sounds good.
All right, lady, thank you so much.
You're welcome. Thank you. It was fun.
This my head doesn't hurt. I'm so happy about that. Thank you so much. Have an amazing rest of your day.
You too. Appreciate it.
Thank you, love. Bye.